Welcome to the BF Anderson Technical Report for February the 7th. Things are looking a lot better. I want to get right into the charts because we're seeing a lot of interesting activity here and we're seeing some strength. Now, we all remember the lows set back in December. We have since rallied up to 7,400 on the NASDAQ, and you can see here that we're now getting a golden cross, which is the 25-day moving average is crossing above the 50-day. So we are definitely on a buy signal on this particular index. NASDAQ is looking much better. Now, on a weekly basis, last week we saw a very strong above average volume week. We're approaching that 35-week moving average. It'll be very important to note that if we can break through the 35-week moving average and the 35-week moving average then turns up, that will be a big positive. Now, we're still of the opinion that we could have a retest of these lows, but we'll just have to take it a day at a time. It's really hard to figure that out. Now, on the advanced decline line, you'll notice here that the advanced decline line has been in an uptrend, a little bit of a pullback here. Yesterday we had more decliners than advancers, but you can see overall for the last, say, 5 days, we've had real good results on the advanced decline line. And remember now, we've had that 2-to-1 blast off that came after December the 24th. We got advancers outnumbering decliners 2-to-1 for a 10-day period, which is very rare. It's only happened 10 times since 1960 and has always led to exceptionally good gains in the market in the following 3, 6, and 12 months. Now, here is the high-low index. This is a little bit concerning. Now, remember what we're doing here on the high-low is we're taking the number of new highs divided by the number of new highs plus new lows. We got a very deep oversold condition here back on December the 24th, but since then we have blasted off, like the blast off indicator I talked about earlier, and we've gotten way up here into in what I would say maybe a little bit of an overbought zone. Maybe the market could pull back. We could see a correction in here. However, day by day, you take this every single day. Yesterday we only had 5 new lows, and you can see here that the new lows have really dried up. We're not really seeing a lot of new lows. Well, also the indexes aren't hitting new lows either, so we're in pretty good shape there. Now, the really good news for me is the long-term indicator. Been very concerned about the potential of a death cross. However, the index, meaning the S&P 500, has now gotten back above 2,700, which was kind of a key area. And you can see as a result, we're starting to see an upturn in that 10-month moving average, and the 20-month moving average is definitely in an uptrend. So on a long-term technical basis, the uptrend appears to be resuming. Put-call ratio, fear-greed. You can see here that we are starting to get more into greed after being in extreme fear. So, sentiment is starting to become neutral. It's no longer as positive as it was back here. In other words, you want to be more aggressive when everyone is fearful, and you want to be defensive when everybody is greedy. So, we are heading towards greed. Now, I wanted to point this out. I think this is a very important concept to understand. Since 1990, if we take the Value Line Geometric Index, which is an equally weighted index. Now, if you look at all the other indexes, and we've talked about this before, but if you take all the other indexes, the S&P, the NASDAQ, the Russell 2000, any of them, they're all market cap weighted, which really doesn't make a lot of sense because I don't market cap weight my portfolios, and I equally weight my portfolios, and most people do. So when you start looking at these indexes that are market cap weighted, it means that the largest companies within the index are going to drive the index. So there's a possibility that you could have 4 or 5 stocks completely driving the Dow Jones 30. In other words, 25 stocks aren't doing anything, but 5 stocks are doing everything, and they're the biggest stocks in the index. So it's kind of deceptive. But anyway, if you look at this Value Line Geometric, since 1990, we've been locked basically in a trading range, which means that since 1990, for over 20 years, the market, the average stock, according to the Value Line Geometric, has really gone nowhere. However, we got to this low in '09, which was the financial meltdown, the financial crisis, and you can see ever since then it's been pretty much in an uptrend. And so, 2016 rolls around, we have Brexit and the election, and we break out of this box for the first time in 20 years. But then with this most recent correction that we had back at last year, it pulled us right back into the box again, but the uptrend line still is intact. So the good news here is that we have now resumed back above the box, and hopefully that means that we're going to start doing this and we get into a good, solid, long-term uptrend. But I know when people look at this, they go, that's a real negative that the market hasn't gone anywhere for 20 years. Well, in a way, it is a negative, but it's also a positive because it means that most investors are not interested in the stock market right now because it's been dead for so long. Now, the same thing happened between 1966 and 1982. The market went nowhere for 16 years, and then in 82, when Ronald Reagan came in, the Dow broke above 1,000, and Katie barred the door. We were in a major uptrend that lasted for about 16 years. So if you think about this, what this is just a buildup of potential buying power is what this means. People are doing other things with their money. They're buying bond funds, they're doing, annuities, they're buying gold or whatever it is they're doing, Bitcoin, who knows. Point is, there's a lot of fuel that could come into this market. So this is very bullish. Now let's get into the top 5. Now the top 5 are really interesting this week, and what continues to jump out at me is that the top 5 list is dominated by software stocks. Now these are cloud-based software companies. In other words, you send a signal from your mobile device to the sky, the clouds, which is a server farm, and Amazon Web Services or Microsoft or whoever's running the server farm. And then these software companies have their software on these servers and can do these miraculous things for you without any wires. It's really amazing. So I'm really perplexed as to whether or not 5G, the next generation of cellular signal or wireless signal that's coming, I hear it is a very big deal. I do believe it's a very big deal. And so I think these software companies, these cloud-based software companies, are real big beneficiaries of any advancements in the wireless signal. So this is Coupa Software, hit an all-time new high. The stock is actually going up in a parabolic fashion, and you can see the moving averages have turned up as well. Now here's another software company. They announced earnings. You can see the earnings gap here. Skyscraper volume, stocks breaking out to all-time new highs. This is ServiceNow, another cloud-based software company. Let's see here. Now we have another cloud-based software company that has to do with the healthcare industry. This is Veeva Systems, another cloud-based software, new high. You cannot ignore this. This is very important. Here's another software company, a company called Workday. This is another company that is they just signed a deal with a company called Accenture. Stock's hitting new highs. Very strong pattern. We do own this stock, I have to disclose. Now, we also own this stock here, a company called Xilinx. This is a semiconductor manufacturer. You can see the skyscraper volume, the earnings gap. This is a very, very interesting company. This company, the reason the earnings were so good was that they were involved in selling the chips for the build-out for the 5G network in South Korea and China. So, as it comes here to the United States, which it's going to, this company should benefit, these chip companies. Now, we're looking at another chip company called Broadcom, which we took a position in yesterday. So, in conclusion, the market's looking better. History does say that, we have the chance of a pullback and a retest of the lows. But I think the best answer is to keep an eye on the new lows, keep an eye on the trend lines, keep an eye on the 35-week moving average, all these types of things, and just take this a day at a time. Because if we don't get the pullback, and a year from now the market's up 20%, you're going to be really regretting the fact that you're sitting in cash. Okay, let me know if you have any questions. Thank you very much.